Hi, my name is Catherine Jarrett, and I would like to discuss corporate finance and chief marketing officers and talk about just what this means and what they do for a business. Understanding the role of the finance manager and their place in the organization is very important. The CMO is at the heart of driving growth for every business. So what does the finance manager do? They prepare financial statements, business activity reports, and forecasts. They also monitor financial details to ensure that legal requirements are met. They supervise employees who do financial reporting and budgeting. They review company financial reports and seek ways to reduce cost. They analyze market trends to find opportunities for expansions or for acquiring other companies, and they help management make financial decisions. So, how does the financial cycle look? This is something very important that a CFO or CMO looks at. And so when looking at that financial cycle, we have to consider the fact that most businesses pass through a series of well-defined stages based on their level of development. In the first stage, a new company begins with the seed of an idea. After the firm is able to acquire external funding and develop its product or service, it enters into the growth phase. And then eventually all possible customers have their product or service in their hand. So when the firm has reached the final stage, sales can stagnate or decline due to replacement by a better product or competitor. So this is something that's always in the forefront and something to consider when you're going through that financial cycle. There are 4 types of firms that a CFO or CMO will deal with. Those 4 firms are 1, sole proprietorship, 2, an LLC or a limited liability corporation, a corporation, and then a partnership. So let's first talk about the sole proprietorship. As a sole proprietorship, it's a unincorporated business that's owned by one individual, making it the simplest form of business to start and operate. As a sole proprietorship, you own 100% of the business and get to make all the decisions. You also do not need to file a separate business tax return. All income generated from the business is reported on the personal tax form. Now, while tax simplicity can be an advantage for sole proprietorships, it can also be a disadvantage in terms of flexibility, as all business income must be reported as regular income in the year in which it was earned. So raising capital is more difficult as well for a sole proprietorship. And then lastly, it can be difficult to sell if the business is completely tied to one owner. So sometimes that makes it hard to sell. Next, I would like to talk about limited liability. A limited liability company, or an LLC, is a corporate structure whereby the members of the company cannot be held personally liable for the company's debts or liabilities. Limited liability companies are essentially hybrid entities that combine the characteristics of a corporation and a partnership or a sole proprietorship. Now, unlike corporations, which can issue stock in order to increase funds for other companies, LLCs have to work a little harder to find investors and sources of capital due to the greater legal obligations and state filings involved to add a new member to an LLC. And because of the protections afforded to LLCs, there are some types of businesses that are ineligible to file as an LLC. Some of these examples are banks, insurance companies, and medical service companies. These are businesses that can actually be barred from filing an LLC in their specific state. And lastly, I want to talk about corporations. A corporation is a legal entity that's organized under state laws, whose investors purchase shares of stock as evidence of ownership in it. The shareholders of a corporation are only liable up to the amount of their investments. The corporate entity shields them from any further liability. Now, depending on the type of corporation, it may pay taxes on its income, after which shareholders pay taxes on any dividends received. So, in that respect, the income can be taxed twice. If there are many investors having no clear majority interest, the management team of a corporation can operate the business without any real oversight from the owners. And with a partnership business is a legal relationship formed by the agreement between 2 or more individuals to carry on a business as co-owners. A partnership is a business with multiple owners each of whom has invested in the business. Some partnerships include individuals who work in the business, while others may include partners who have limited participation and also limited liability. Each partner is jointly liable for the partnership, however, for the partnership's debts. That is, each partner is liable for their share of the partnership's debts, as well as being liable for all the debts from the business. So there is a risk of disagreements and friction amongst partners and the management team in a partnership. So each partner is an agent of the partnership, and they're liable for any actions that their partners take as well. So now we've talked about CMOs and CFOs, and so what are the ethical issues that CMOs and CFOs face? Well, there are many pressures that encourage unethical behavior with respect to financial dealings. They are very much connected to the same goals that drive individuals to superior performance. Motivating factors like survival, maximizing profits, minimizing cost, avoiding bankruptcy or financial distress, beating out the competition or expanding one's market share are all examples of why management may misrepresent their financial position. However, one should never rule out personal gain being a driving force behind unethical financial practices as well. The Bible warns us against greed. In Ecclesiastes 5:10, it says, "He who loves money will not be satisfied with money, nor he who loves wealth with his income. This also is vanity." Thank you for listening, and God bless.